Gold's rally over the past couple of months has been nothing short of spectacular, and the price of gold has now reached $4,000 per ounce for the first time in history. And if any of you, like me, have been holding and stacking gold for years now, this may feel like a long and well-deserved victory. But at the risk of sounding like a complete doom and gloomer, this may not be the victory lap that we were hoping for, because moves like this in gold don't happen out of nowhere. And the signs point to the fact that this might be signaling something pretty bad coming down the pipeline. Let me show you what I mean. The first thing I'd like to show you is gold during 2014 through 2019. It was moving sideways, consolidating, bouncing around between support and resistance of about $1,100 an ounce to about $1,300 or $1,400 per ounce. About halfway through 2019, it finally broke out, and within 1 year, the price of gold had increased 50%. It topped out in August of 2020. Now, a couple of things that are important to note about that massive move in gold. Number one, a good majority of that move happened once the money printing started. But number two, that move actually began in around June of 2019. That was before the repo market crisis happened in September of 2019 and well before any printing or QE happened starting in 2020. And this is the first thing that you have to understand about gold, is that gold anticipates the consequences of monetary policy. If you take a look at this chart again, you'll see that gold topped out in August of 2020. Now, I know that was over 5 years ago now, so you might forget, but inflation of goods and services had not yet begun in August of 2020. In fact, it wasn't until March of 2021 that the CPI finally got back above 2.5%, and then it flew up from there, peaking in June of 2022. Yet gold's move had already happened and gold started moving sideways from there. But it wasn't just goods and services. The move in gold ran ahead of the move in other assets that were also responding to monetary policy. If you look at the S&P 500, you can see that by August of 2020, the stock market had not even recovered to its previous all-time high. Yet gold had already topped out, had already made its stellar run. And it was from there that the S&P 500 embarked on its massive rally, finally peaking at the end of 2021. Again, gold anticipates the effects or the consequences of monetary policy. And given the fact that the price of gold is up almost 100%, it has almost doubled since it broke out from its last consolidation pattern in February of 2024, this begs the question, what in the world is gold anticipating this time? Because the move would suggest something different or more extreme than what happened in 2020. Don't worry, I'm going to get to that. But first, I do need to explain why I think gold anticipates the effects of monetary policy so well. And the number one reason is because the biggest buyers of gold are the monetary policy makers themselves. It is the central banks. For the first time in decades, gold holdings as a percentage of foreign reserves are now greater than US Treasury holdings as a percent of foreign reserves. This is foreign central banks, now for the first time in decades, hold more gold as a percent of all their foreign assets than they do US Treasuries. Now, certainly, a good chunk of this is due to the fact that the price of gold has been rising. But as we can see, for years now, central banks have been continuing to be purchasers, large buyers of gold. So the people who make the decisions about monetary policy are also some of the biggest buyers globally of gold. And we also have correlation between large moves up in gold and coming easing, but we also have correlation between gold anticipating the effects of coming tightening. Take, for example, when gold topped out in August of 2020 and then moved sideways until 2024. That entire time period, central banks were tightening, trying to deal with the consequences of their own actions. They were raising rates and doing quantitative tightening on their balance sheets. And before that ever started, just when the mention of or the knowledge that that was going to happen hit the markets, that's when gold topped out. The tightening didn't start in 2020. It took a long time, but gold anticipated that and moved sideways. Now, there's one asset class that tends to do very well after moves in gold, and that is resources, energy, commodities. You can see this copper mining ETF, from the time that gold topped out in August of 2020, ran up an additional 121% from there. If you're interested in hearing my game plan for how to play this commodity super cycle, I have an invitation to a beta test for a new program I'm starting. And as of the time of this video going live, there's only 3 days left to join the beta test. If you're interested in learning more about this new service that I'm launching, you can get access to a replay of my webinar that I just did by clicking on the link in the description below. If you're thinking about it, do it quick because the time is running out. Okay, so at this point, lots of people are looking at the price of gold and thinking this looks like a flight to safety, but that's not actually accurate because Bitcoin is at all-time highs. The S&P 500 is at all-time highs. The Dow's at all-time highs. The Russell 2000's at all-time highs. US home prices are at all-time highs. So there's no flight to safety from risk assets. This is not a traditional flight to safety where investors are dumping risky assets for safer assets like gold. Usually that is accompanied by treasuries as well. And you can see, even though the Fed just cut rates, the 10-year yield is up since then, which means treasuries are getting sold off right now. So we're not seeing a traditional flight to safety right now. So what is going on? And why do I think this is a sign of larger economic trouble to come? It's because we are staring into the abyss of a sovereign debt crisis. For decades now, every major economic crisis has been bigger than the last one, and it has manifested in the place that absorbed the consequences from the prior one. In 1998, a small hedge fund named Long-Term Capital Management failed, almost brought down the global financial system with it, so the Fed forced the banks to orchestrate a bailout. Fast forward about 10 years, the Great Financial Crisis happens, and who is it that needs bailing out this time? The banks, who absorbed the last one. And so the taxpayers were forced to bail out the banks. Fast forward 12 years from there and you get to 2020. This time the taxpayers, the entire economy, are on the verge of a collapse through lack of liquidity that started in 2019. And so the big print happened in order to bail out the taxpayer. And I understand most taxpayers didn't get that much of a bailout, but there were stimmy checks sent out. There was large scale printing that contributed to a growth in the money supply by a lot. And that economic time bomb was this time absorbed by the US government itself, taking on trillions and trillions in extra debt and extra spending all at once, setting in front of it an irreversible course of ever-expanding deficits. While extreme, this is a similar situation that every government around the world went through, and now we are facing a global orchestra, a symphony of sovereign debt crises manifesting all at once. The central banks know this, and they are stockpiling gold to get ahead of it, because the central banks know that they're the ones that are going to have to absorb the bomb this time, because there are only a few ways out of a sovereign debt crisis. Number one, austerity. The government can simply choose to spend less money, balance the budget, reduce taxes as well, and that would solve the problem. But there are too many people on the take. There are too many people on the receiving end of all of the grift that would be unhappy with them not receiving anymore what others have produced. So therefore, austerity gets thrown out the window. The next possibility is to outgrow the debt. This is certainly what the current administration thinks they are trying to do, but every action taken so far for the last year or so indicates that policy will be more preventative to outgrowing the debt rather than helpful for it. There are certainly things happening right now like AI and robotics that mean we could potentially have a large explosion of growth in the near future, but that is yet to be seen, which means we're left with the third option, which is to just print our way out of the debt. That's where the central bank comes in, as the central government borrows free money, interest-free debt, from the central bank in order to fund its expenses and pay its debt to others. This is unlikely to cause hyperinflation of the US dollar, though it is very likely to lead to a very prolonged period of time with much higher inflation than people are expecting, much higher valuations across all asset classes than most people are expecting, as people move their purchasing power into assets to prevent their purchasing power from being lost to inflation, and also much higher interest rates for much longer than most people are expecting. And so while you can absolutely protect yourself and you can financially benefit from knowing these things are coming and positioning yourself correctly, it is unlikely that we are about to enter into a period of time of rapid and well-distributed growth and increases in wealth. In other words, most people are going to be left behind. The differences between the haves and the have-nots will probably become more extreme, and volatility in the economy, markets, and the social order are likely to grow as well. Again, if you'd like to hear my entire playbook for how I am positioning myself and receive an invitation to a new beta test that I'm starting because of what's going on right now, click on the link below and do it soon because time on my beta test invitation is running out quickly. As always, thank you so much for watching. Have a great day.